Okay, good morning, everybody. This is Erik Daly speaking from Miller Johnson. I am a member in our corporate and mergers and acquisitions group. I'm joined today by Rebecca Strauss, who's a member in our labor and employment section, and by Tripp VanderWal, who's a partner in our employee benefits section. Today we're going to be talking about small business and programs that may help during these challenging times. And as we like to do at the start of our webinars, we revisit what we're pursuing here, which is to collaborate with the community, with our clients, with governmental organizations and chambers of commerce to deliver information that is helpful to the business community in navigating these very difficult and unprecedented times. We know that you all value collaboration, intellect, loyalty, candor, and ingenuity, and so that's what we are trying to bring. Before we continue, we also would like to just visit a few of the headlines from the last 24 hours related to the coronavirus situation to provide a kind of a level set before our discussion. So a few items that we'll call out. Michigan coronavirus cases are up above 2,000 now. So look like as of last night, around 2,300, maybe more now, I'm sure. There were some signals that the social distancing measures that were put in place in New York City may be helping to mitigate some of the further spread there. So that's something that I'm sure other states will be keeping an eye on, and other cities as well. The business community here in Michigan is obviously still looking for more clarity on the executive order that was implemented earlier this week related to critical and non-critical infrastructure businesses and which businesses may or may not operate. So that's something that continues to evolve. And then most relevant for purposes of this webinar, the Senate, the United States Senate last night unanimously approved the CARES Act, which is we'll call it phase 3 of the federal response to the coronavirus, the COVID-19 situation. The final bill, I think, came in at about 880 pages. It is filled with many different substantive measures to address economic issues, systematic healthcare issues, funding shortfalls. So today we're not going to be attempting to address all of the aspects of the legislation, but we'll really focus on the parts of it that will be most relevant to small businesses. And it's important to remember at this point that legislation is not a law yet. It's been approved and passed by the Senate. It sounds like the House will take up a vote, probably by voice vote, on Friday morning to in all likelihood approve that and then send it to the president for signature, at which point it'll actually be law, presumably. So with that caveat, why don't we continue on with our presentation? I'm going to jump right into it on the CARES Act measures that may be most top of mind for small businesses. As I mentioned, there's new federal stimulus for small businesses. I think the aspect of this that'll probably be most relevant for the group is retention loans or paycheck protection loans. I put loans in quotes because depending on how the funds are used, they may not need to be paid back. They may be forgiven. And we'll look at some of the other provisions that were included in the final bill that may be available as a funding mechanism or may otherwise impact small businesses. And we'll also look at some of the provisions that impact individuals who may be employees of small businesses, because that obviously impacts how employers are thinking about responding to the overall situation. We'll also talk about SBA disaster loans, which were already in place as an available funding mechanism prior to this legislation and continue to be available as a potential source of financing, but they can't be used for the same purpose as the new Paycheck Protection Program or retention loans that we'll talk about first. We'll then briefly touch on some Michigan small business relief programs, and then very quickly just visit the notion that there are other state, municipal, and private programs that may be available. So why don't we keep moving? Okay, the federal stimulus legislation, the retention loans are funded from a $350 billion allotment for loan guarantees. And actually there's another, say, $17 billion on top of that to deal with forgiveness of existing SBA loans, and we'll get to that in a minute. So the number is probably really 367 or more, 367 billion or more. So you may hear these loans, again, quote unquote loans, referred to as paycheck protection or retention loans. And the purpose of the loans is to support cash flow needs to cover payroll costs, but also other permitted expenses, which go beyond just payroll and employee-related expenses. So other overhead items like utilities and mortgage payments, rent payments. Really, there's a slew of things that the proceeds from the loan may be used for. So one misconception may be that it can only be used for payroll costs, and that's not the case. But there are limits on what the proceeds of the loan can be used for. The loan forgiveness is based on employee and wage retention through the covered period. So there's two tests, and we won't get into all the details because that would be probably an hour-long webinar of its own. But basically, if you want this loan forgiven, if you use this type of loan, there's a requirement both to retain a certain level of employment or payroll levels, but also not to reduce wages beyond certain percentages. And there's a pro rata reduction in the amount of forgiveness for these loans, as you either reduce payroll in terms of number of employees or reduce wages for employees. The loans are generally going to be available to businesses with fewer than 500 employees, although some industries have different tests that are specified by the SBA. So some larger businesses in terms of employee count may be eligible to participate in the retention loan program if you're in a unique industry. And again, maybe beyond the scope of this particular presentation, but it's something worth exploring. I think of any industry, I think the highest number of employees that would potentially qualify would be 1,500, although there is some relaxation on kind of affiliation rules for entities that have, affiliated businesses that when aggregated might have more than 500 or 1,500 employees. So there's some technical nuances there that may allow businesses that do have more than those numbers of employees to potentially be eligible for the retention loan and the payroll protection loan program. This is also going to be available to self-employed or gig economy workers, which is a kind of prevailing theme of many of the benefits in the CARES Act, that the Senate bill has extended a lot of the benefits to recognize that portion of the economy, and it's not where they've not been universally considered for certain benefits or participation in certain programs in the past. In many cases, they are now in this bill. And then 501c3 organizations also generally eligible to participate in the payroll protection and retention loan program, and certain veteran organizations are as well. That's not on the slide, but that's another type of 501c group that may be eligible. Let me continue. Okay. The retention loans are really a temporary form of a small business administration loan. So it adds an additional means for the SBA to provide loan guarantees to borrowers, and the process for getting the proceeds out to borrowers and to businesses will be much more streamlined and less information intensive than most SBA, of any other SBA loan program, even the pre-existing disaster relief type of SBA loan program. So much less information will be required, and hopefully the response time will be much faster. That seems to be a strong prevailing theme of all the communications related to these programs. The size of the loan available to a small business will be equal to 250% of an employer's average monthly payroll. And again, there's some technical determinations to be made here about which, how you determine what your average monthly payroll is, which period you use as a reference period, depending on, if you're a seasonal business or something. But basically, the idea is you would look to a comparable period, and then it would be 250% of the monthly payroll, subject to a $10 million maximum per loan. These payroll protection loans can be used to refinance recent SBA disaster relief loans. So if a small business has already applied for and been approved for a loan under the SBA disaster relief program, you could also apply for this program and either refinance the previous SBA disaster relief loan, or if you use them for different purposes but permitted purposes, you could have both, although that may be unlikely to be a desirable option. In many cases, it's possible. Importantly, there are no personal guarantees or collateral required for the payroll protection loans, which is a big difference compared to even the SBA disaster relief loans, where 20% owners are generally required to provide guarantees, and any loan above $25,000 would typically require collateral if it's available. Here, it's not even a consideration, specifically suspended for purposes of these retention loan program awards. Similar waiver of a requirement that would typically apply in the context of an SBA loan is that there's no what we call credit elsewhere testing for these payroll protection loans. So you don't, under a normal SBA loan application process, including the normal disaster relief process, there would be a determination made about whether the business can obtain credit elsewhere. That, in other words, from a private institution, a bank, through a more conventional commercial loan, that credit elsewhere testing is suspended. Again, this is on the theme of getting the money out to businesses in need as quickly as possible. In the rare case that funds are not, relieved because the proceeds of the loan weren't used for the permitted purpose, or there's a reduction in employee headcount or wage level, the loans are subject to a 10-year maximum term and a 4% maximum annual interest rate. Although I think most businesses who use this, this type of loan would, hopefully that consideration wouldn't be relevant, as they'd hopefully be aiming to use it as more of a grant or a forgiven loan, not to be repaid. In the press conference yesterday, the daily briefing, Secretary Mnuchin was discussing this program and said that Treasury hopes to have things available to go for potential borrowers as soon as possible. And in terms of getting the money out, they said that their aim is to be able to accept requests and make disbursements on the same day, potentially by the end of next week. And we'll see. I'm a little, I guess, skeptical about that, but it's possible. This will require a great deal of coordination with local of banks who are eligible to process SBA loans, and so how that's going to work with coordinating the disbursements of these loans through banks and on a same day basis. We'll see, and we'll keep people posted with alerts about that as it develops, presuming that this does become law. There's no fee to apply for these retention loans, nor is there any fee for the banks that would be processing the applications to process the loans. So on both sides, there's a recognition that those might be impediments to participation either on the funding or on the borrowing side. So the fees won't apply during this extraordinary time, and there would be no prepayment penalties associated with this funding mechanism. Keep moving. So some other provisions. These are some examples of selected additional funding for specific industries that may be relevant to certain businesses that are above and beyond the $350 billion for the small business Paycheck protection program. So there are many industries that were called out here. Some of the the examples. I think hospitals and healthcare, something on the order of $130 billion, maybe more in the final bill. National security, critical national security contractors or industry participants, I believe $17 billion. Passenger airlines, cargo air carriers, aviation, airports, education, and then numerous others. And then beyond that, there's a $450-ish billion pool of discretionary funds that Treasury and the Fed would be able to use for distressed industries that may be larger businesses, but also medium-sized businesses, and potentially for small businesses. There was some express language about potentially using some of these funds to set up a kind of a Main Street lending program. So it's possible that some portion of this additional $450 billion may become available to small businesses, but we'll have to see. And it'll be subject, this portion of the funding under the bill is subject to some oversight that was negotiated into the final bill over the last couple of days, where there'd be an independent inspector general and then a congressional oversight group as well. This portion of the funds also comes along with some of the restrictions you may have read about in terms of limiting dividends and stock buybacks, executive compensation changes, layoffs, and things like that. So, but I would expect most of this $450 billion would apply for larger or medium-sized businesses. So we'll keep going. So other aspects of the CARES Act that relate to other SBA products or ways to get relief as a small business. There was a strong effort to make the core concept of the Paycheck Protection Program applicable to existing SBA debt. So there may be some small businesses that already have SBA loans, and the CARES Act provides that there will be relief for 6 months of certain principal, interest, and other fees for those SBA loans that were granted prior to the COVID-19 situation. And a lot of the permitted uses and relief criteria are again tied to the employee retention and wage stability provisions that I briefly touched on earlier. So, you know, this is really meant to make a situation where the existing SBA borrowers are not, you know, worse off than a new applicant who is seeking a paycheck protection loan. So that, you know, you wouldn't need to necessarily refinance your existing SBA loan into, for example, the Paycheck Protection Program, because you'll get this 6-month relief. And I would emphasize again that this is not, if you use those loan proceeds for the permitted purposes, it is relief. It's not a deferral of those payments. So it's not like when that 6-month period ends, you have to go back and pay those amounts. It'll be true relief from those requirements during that 6-month period. Another potential source of liquidity in the near term are SBA emergency grants. These grants allow small businesses that apply for the economic injury disaster loans, which we'll talk about shortly, to have expedited access to capital through grants that would not be required to be repaid, even if the application is ultimately denied. These $10,000 grants kind of go out the door very quickly. There are some self-certifications required and permitted uses of the proceeds, but basically it's meant to be quick funds out the door within, say, 3 days to maintain payroll, provide sick leave, service debt, et cetera. And even if you're ultimately denied participation in the disaster relief program, you're not required to repay that $10,000, although I think it would factor into your loan forgiveness if you ultimately are approved or refinance into the payroll protection program. And there's $10 billion allocated to support this emergency grant program. Let's keep going. Okay. Some additional provisions related to the SBA programs. The SBA Express program, which, you know, is kind of like a working capital line of credit, has been increased. The maximum amount available has been increased from $350,000 to $1 million for the covered period here, which I think in this case, if I remember correctly, this will be at least through the end of this year and maybe longer. But there will be an increase in sort of the available capacity under those express lines of credit. I'm sure we'll touch on a couple of these other tax-related issues either later in this webinar or in further client updates or webinars, but in terms of additional sources of liquidity. There will be a deferral of a very significant deferral of the employer's share of payroll tax, and there will be a tax credit for retained employees. And again, this is another incentive created to keep employees on payroll. There will be funding for entrepreneurial assistance programs that will essentially help counsel, train, and make businesses aware of the availability of the programs that I've just described, and the application process, as well as a variety of other things like how to implement telework, how to operate safely, and adjust your supply chain in the context of the current situation. So there will be educational outreach to folks to help them navigate this process. Let's keep going. Okay, I'll go through these quickly. These are some of the items in the CARES Act that impact employees, and I bring them up because it's important, obviously, for a small business weighing its options for how to proceed in this environment to understand what the employee's perspective is going to be on available benefits and other programs that they may be eligible to participate in. So a couple of the core things is, there's a $250 billion allotment for basically direct payments to individuals and families within a certain adjusted gross income range, $1,200 per adult and $500 per child. You can see the range of adjusted gross income there, $75,000 to $99,000 for individuals. For people filing jointly, you can basically double those amounts to get to the same, to get to the adjusted means testing. This last sub-bullet point here with the adjusted gross income calculations based on 2018 tax returns, that assumes that an individual hasn't filed for 2019 yet. I believe if they have filed for 2019, then the Treasury would use those figures. And in all cases, there will be a potential one-way adjustment based on 2020 adjusted gross income. So, for example, if somebody doesn't initially qualify because they were outside they were above the $99,000 in 2018 or 19, but then fall well below that in 2020, somewhere down the line, and for the 2020 tax year, they'll get a credit for that. And it's just a one-way adjustment. There won't be, it can only benefit an individual, I guess is the best way of saying it, when you get around to the adjustment. Other programs, there are going to be student loan payment and interest suspensions through September 30th, and foreclosure and eviction protections for people who have federally backed mortgages or whose landlords have federally backed mortgages or other federal funding that the legislation could be tied to. Let's keep going. The other big item, which was one of the major negotiation points down the stretch before the Senate finally voted to approve this late last night, was the very, very significant expansion of unemployment benefits, and significant in terms of who's eligible for unemployment benefits and also the amount. The legislation includes some triggers, which I won't go through right now. I'm sure that we can cover them all and summarize them in a different forum, but it'll expand the number and type of people who are available for unemployment insurance and for unemployment payments. The key thing here to think about is that in addition to whatever state unemployment may be available, qualifying individuals will get an additional $600 per week from this federal program. So it's not capped at prior year earnings, for example, which is what some senators sought as an amendment to the legislation. It's just a flat additional $600 payment for 4 months on top of whatever state unemployment may be available. And it extends unemployment insurance by 13 weeks. Also applies to self-employed and gig economy workers. Again, kind of a prevailing theme of the legislation is extending those programs to independent contractors, self-employed, and gig economy workers, thinking about like Uber drivers as an example. This expansion of unemployment benefits retroactive to January 27th and will apply through the end of the year. Another thing to think about for employees and how they kind of weather the situation, and there are many that I didn't cover here that just didn't rise to kind of the key points for the small business program, but retirement plan flexibility, there's relaxation of penalties, for example, for withdrawals from 401ks, or I think an expansion of being able to take loans from retirement savings. Let's keep going. Okay, so pivoting back to the SBA programs, the SBA economic injury disaster loans are a product that already existed pre-CARES Act, so prior to last night. And I guess the other program doesn't technically exist yet since it hasn't passed the House and been signed. But this economic injury disaster program is available right now. It's already part of the landscape for small businesses. This could be used in addition to the retention or paycheck protection loans, but you cannot use it. A small business can't use this type of disaster loan for the same purposes as the payroll protection loan, so it would need to be for a different purpose. There's a temporary expansion of eligible borrowers under this program. And one that jumped out to me that might be relevant to this group is that ESOPs for small business ESOPs or employee stock ownership plans may well qualify as temporary eligible borrowers under this program. Something to keep in mind if the ESOP has liquidity issues as a result of this. The loans under this program are capped at $2 million with interest rates capped at 3.75% and 2.75% for not-for-profits. Repayment terms up to 30 years. These loans are funded directly by Treasury as opposed to the typical SBA loans and the new paycheck protection loans, which are funded through banks and credit unions, but guaranteed by the SBA. Generally, the permitted uses of funds here are working capital issues, so there's definitely some overlap in permitted purposes here and with the new program. But again, if you were to use both, you'd have to use it for a separate purpose. Typically, there would be a security requirement for loans above $25,000, although I think there's going to be relaxation of some of these types of requirements in the current situation. Let's keep going. Again, typically you'd be required to provide significant business and key owner or 20% plus owner financial info. Those information requirements have been dramatically relaxed, or presumably will be dramatically relaxed during the COVID-19 period. And as one example, the legislation says that an evaluation can be made based on credit scoring rather than requiring all relevant tax returns, which outside of this program, would be required even for a disaster relief loan. And then there's discretion granted to the SBA to further streamline the process for collecting information to get these loans out and available. And so we'll expect to see more on that front, I think, as soon as this becomes law. Lending criteria, I think that that will be relaxed as well during this period related to the coronavirus. Those credit history, repayment prospects, collateral. We'll see how much they're relaxed. I think they'll be relaxed significantly, but those would normally apply in the disaster loan relief context. And again, here, no cost to apply, and you're not obligated to accept funds. So really, it's just the investment of time in navigating the SBA website, which I know has been overwhelmed, and a lot of people have had a hard time accessing recently. So we'll go to the next slide. A couple of things specific to Michigan, which is where I'm located. I know we have people on the call from elsewhere, a lot of people from Michigan. There's up to $20 million for small businesses impacted by COVID-19 that are Michigan specific. These funds are expected to be made available April 1st. We won't spend a lot of time talking about these, but there are grants for businesses that are have fewer than 50 employees, and then loans for businesses that have fewer than 100 employees. There's a requirement to demonstrate that there was income loss and impact from some of the state orders restricting conduct of business to be eligible for these programs. And I don't have anything to say about the application forms or process right now, other than it doesn't look like the details are available yet. I'll say that I think that some of this is going to be administered through local organizations throughout the state. There are different organizations that cover different geographic regions in the state, and so I think there'll be a certain level of coordination among the state and those organizations to disperse the loans or grants. Let's go to the next slide. Okay, and then very briefly, some non-governmental programs. A lot of banks have announced, waiving late fees, delayed payments, and announced flexibility for those sorts of things. So you may check to see if you have a loan outstanding already or commercial debt, you may just check to see if there's flexibility already offered by your bank or inquire. And then these are just two examples of some miscellaneous programs offered through the private sector, but there are many others, and there are some good resources online that have compiled lists of these types of programs, some of which are industry specific, such as the food and beverage example here for micro grants. Given the timing, why don't we keep moving on the slides? Okay, so I'll stop there. I see there's been a lot of questions that have queued up, and I'm going to turn it over to Tripp and Rebecca to talk about some of the employee benefits and employment law issues, and I will look through the questions that have been typed in, and we'll revisit some of those time permitting later as well. Tripp or Rebecca?
Thanks, Erik. This is Rebecca Strauss. As Erik mentioned, I'm an employment lawyer here at Miller Johnson, and it's a pleasure to start my day with all of you, although I wish it was under better circumstances. I'm going to talk to you about benefits that are available to small businesses, and in some instances, others, larger businesses as well, as it relates to getting money into your employees' pockets. This is a very unusual time in my experience, because this is not the way conversations typically start with employers in my practice. We talk about fighting unemployment and that sort of thing and keeping payroll down. The conversations over the last week or two is how can we do what we need to do to protect our business, but also protect our employees, right? Get the most amount of money in their pockets during this time. So I'm going to tell you about the various opportunities. First of all, the state, this is only a week old, but it feels like old news now. The state expanded unemployment benefits to 26 weeks, included the reasons that you can qualify for unemployment, most notably caring for children if children's schools are closed, and we know all schools are closed in Michigan, but it did not increase the weekly benefit amount, which is capped at $362 per week. So now let's talk about the Federal CARES Act, because that expands this significantly. This is the act, as Erik mentioned, that passed the Senate last night. It still has to go through the House and be signed by the President. So with everything that we're all saying this morning, just keep in mind this is just what's been through the Senate. The House was involved in the negotiations with the Senate, so we don't anticipate at this point major changes, but that's an important caveat that you all need to keep in mind. Okay, so the proposed, the CARES Act, as Erik mentioned, but I'm going to go into a little more detail, it expands the benefit amount. It adds on a flat $600 for everyone that qualifies for the reasons that I'm going to explain to you in a minute. That is not capped by folks' actual income. We already got one question in, which is, I'm just going to answer it out loud to all of you instead of just typing a response. This means that some people will make more in unemployment than they actually earned in wages. That is correct. That is correct. For folks that usually make $14 an hour, they will get more in unemployment benefits every week than they earned when working for you. That creates interesting incentives for employees. So you need to keep that in mind. You're going to get tremendous pressure, right, to close you. If you are still operating, if you do employ critical infrastructure workers, because of this, in my opinion, you're going to get incredible pressure from a lot of your employees, particularly the ones that will make out better in unemployment, to close your business because of the executive order, because they'll get paid more. In addition to giving everyone $600, it also expands the benefit period to 39 weeks. So Michigan, again, in old news, Michigan increased it to 26 weeks. Now it is increased to 39 weeks. The reasons that you can qualify for this additional $600 unemployment benefit, some the obvious ones, right? You're diagnosed or symptomatic of COVID-19. Okay, you don't need, that's important. You don't need a positive COVID-19 test result, but you can be diagnosed or symptomatic. You, someone in your household, or you're providing care for someone with symptoms. Next slide, please. Other reasons, this is real important. Your child's school or daycare is closed and you need to stay home, right? That's a major issue for many working parents in the state right now. If we go towards the end of the slide, you are unable to reach your place of employment because of COVID-19 public health emergency. Okay, what does that mean? Governor Whitmer's, we call it a shelter-in-place order, whatever you want to call it, right, that came out on Monday that says you can only leave your home for certain purposes. For employment purposes, you have to be a critical infrastructure worker. If you are not a critical infrastructure worker, you are not allowed to reach your place of employment. If you have determined that you do employ critical infrastructure workers and have told those folks that they have to come to work in person, they may disagree with you and file for benefits, and that's where some of that fight might take place, right? Okay. Another reason is you can't start a new job because of COVID-19 public health emergency. So folks that you've made offers to that haven't actually started yet would qualify for unemployment potentially. Next slide, please. Other reasons, head of a household has died from COVID-19. You had to quit your job as a direct result of COVID-19, and your place of employment closed as a direct result of COVID-19. So all of these reasons would qualify you for this enhanced $600 benefit. That benefit is paid directly by the federal government. It does not impact your unemployment ratings. And if you're a reimbursing employer, you don't have to reimburse that amount. That is a direct payment from the federal government to your employees. Backing up to the state's executive order expanding unemployment, any COVID-19 related unemployment, it doesn't affect your rating, and for reimbursing employees, you do not have to reimburse. Okay, next slide, please. Employees do not qualify. They do not qualify if they can still telework and get paid for teleworking from home. Okay, so if you tell someone work from home until the crisis passes, assuming they can still care for their children as well, they do not qualify for unemployment. The last bullet point is extremely significant. If they're receiving sick leave or other paid benefits, they do not qualify for unemployment. So that leads directly into a discussion of the Families First Coronavirus Recovery Act, because those do, for small employers, that's 500 and under, it does require you to pay sick leave and other paid benefits for coronavirus issues. Next slide, please. I'm going to go through these very quickly because we've already done 2 full hours of webinar on this act. They're recorded and available to you on our website, and frankly, they are excellent. So the slides include content, but this is really meant as a review, and if you need to dig into it, please, please, please go to our other webinars that discuss it in more detail. But basically, the FFCRA obligates small employers, 500 or under, to provide 2 weeks of emergency paid sick leave, capped at either 200 a day or 511 a day, depending on the reason. It expands the FMLA to cover employees who need to stay home because of childcare. They get 2/3 of their pay, and it provides tax credits to the employers for both. So it might create a cash flow problem in the short term, but theoretically, at the end of the day, it should be like a net zero for your bottom line for providing these benefits. Next slide, please. All employers with fewer than 500 employees are covered. That includes nonprofits with fewer than 500 employees. You can, if you have fewer than 50, you can apply to the Department of Labor for an exemption if it would jeopardize your viability. Next slide. All for paid sick leave, that's 2 full weeks of full pay, capped at $511 or $200 a day. Everyone can get it. They don't have to work for you for a certain number of days. Next slide, please. They can take up to 2 weeks, 80 hours. Importantly, you cannot require employees to use other PTO or sick leave that you may already offer in lieu of this. This is in addition to Michigan paid leave, sick leave, PTO, whatever else you offer. Okay, this is an additional 2 weeks. Next slide, please. All the reasons for paid sick leave, all the COVID-19 sicknesses that you would expect, as well as caring for a child because a child's school or place of care has been closed. Next slide, please. It's the benefits are capped at $511 a day if it's for something dealing with illness, $200 a day if it's a child care issue. Next slide, please. Okay, the expanded FMLA, also it's the same coverage, right? 500 employees or less, but for expanded FMLA, it's only for individuals employed for at least 30 days. I'm going to pause here to add something that that was added last night by the CARES Act. The CARES Act already amended this law that's only a week old and said that employees who have been laid off but rehired are eligible for this FMLA benefit. Things are progressing so rapidly in this environment. The FFCRA is effective April 2nd, but as you all know, many, many, many folks have been laid off or lost their jobs already. So what impact does the April 2nd deadline have, right? Generally, most employees who are going to be laid off or terminated, that will have occurred by April 2nd. The Congress might not have anticipated this moving so quickly. They may amend the effective date because of that. For now, it's April 2nd. And so everyone who's already been terminated or laid off wouldn't be eligible for any of these benefits. Someone in Congress realized that, and so they said that if you've already been laid off, you can be rehired immediately before taking these benefits. So even if you've laid people off, they still might be eligible for these benefits if you want them to be, okay, if you rehire them. Right, next slide, please. Eligible employees can take up to 12 weeks off. First 2 weeks are unpaid. That's probably because the paid sick leave will cover the first 2 weeks here. It's only for childcare, and they get 2/3 of their pay. Next slide, please. Okay, it's capped at $200 a day, $10,000 total over the entire period. Next slide, please. You do, as I mentioned, you get tax credits. Again, the first 2 webinars on this provided a lot of detail, and one of our excellent tax lawyers, Neil Williams, was on that webinar, and he can explain this in detail, but it's a credit against payroll withholdings, essentially, which is why nonprofits can also use this. Next slide, please. So how does all of this fit together? This is probably what is on all of your minds now. How does the sick leave, the FMLA, and this new unemployment fit together for your employees? Let's just take an example. Let's just say on April 3rd, right after the effective date, an employee tells you he has to stay home to take care of his small children. Please don't ask him what he's been doing until April 3rd to take care of his children. Maybe he had parents in town or someone else that could help. But now after the effective date, he has a reason to stay home that qualifies under all of these new laws, okay? He qualifies under all of them. What will you do and what will he do? He is entitled to the sick leave and then the FMLA if he wants to take that, right? Those are benefits by law you cannot deny someone. So that on April 3rd, when he comes to tell you that, you can't say, okay, I'm gonna fire you or lay you off, or why don't you choose to leave so that you can just get unemployment and I don't have to pay you the sick leave or the FMLA benefits. Hopefully the Department of Labor will clarify this in the future. But right now, the way that we are reading it, you can't deny those benefits to employees, which means that that employee will essentially have a choice, right, as to whether to stay home and collect unemployment or stay on your stay with you and get these other benefits. And in my opinion, he'll just do the math and figure out how he'll make the most money, right? So if he is an employee that earns $15 an hour, he will come out ahead by saying, I'm going to stay home and collect unemployment, right? Because as we discussed before, it maxes out when you combine the state and Fed at $932 a week. So he will come out better getting unemployment instead of the paid leave, sick leave, and the FMLA. If he's a higher wage earner, let's say $100,000 or more, he will probably come out better using up the paid sick leave and FMLA first. That'll get him through 12 weeks and then flipping to unemployment to get him through whatever else he needs before the schools open back up. Next slide, please. All right, I'm going to just talk just for 1 minute about exempt employees. I've been getting this question a lot from employers and especially small ones. How can we reduce some of our overhead when the FLSA says exempt employees, if they work even 1 hour a week, you have to pay them all week? Here are some options for you. You can prospectively reduce exempt employee salaries. You can't do it retroactively, but you can say from now on, your instead of $100,000, you're going to be making $80,000 as long as it's above the statutory minimum salary for the exemption. You can convert positions from full-time to part-time, and as folks are working from home, maybe they really don't need to work 40 hours anymore. You can do that prospectively, not retroactively. And you can also consider converting your exempt employee to non-exempt just to get through this crisis, so they get paid for the time they work, but not for the time they don't. Next slide. Okay, I'm gonna have Tripp now talk to you about benefits questions that small employers have.
Thanks, Rebecca. This is Tripp VanderWal. I'm a member in Miller Johnson's Employee Benefits and Executive Compensation Group, and I am going to be taking you through some of the top questions, benefit-related questions we've been getting from employers in general, but particularly smaller employers. We're going to cover these relatively quickly because I did, along with my partner Jeff Gray, cover these in more detail in yesterday's webinar, which is available on the recording is available on our website. So the first issue is that we're seeing pop up a lot is supplemental unemployment benefit plans. So very quickly, what are they? These are plans that allow an employer to supplement an employee's state unemployment benefits. I think in the normal course, it is likely that an employee will receive less in take-home pay if they are receiving just state unemployment benefits than they would pay had they continued working. So sub-plans actually allow you, without negatively impacting an individual's eligibility for or amount of state unemployment benefits, to supplement that pay, which of course would reduce the financial burden employees may experience on a leave or furlough or after they're laid off and not receiving the same take-home pay. One of the benefits of subplans is that the benefits paid by subplans are not subject to the employer or employee portions of FICA, so that is an additional cost savings for the employer. They're also not subject to FUTA or state unemployment taxes, at least in Michigan. They are, however, subject to ERISA if you are an employer that is subject to ERISA, which basically means these need to be maintained pursuant to a written plan document. We have to prepare and distribute a summary plan description. And if there's at least 100 participants in the subplan, we may have to file a Form 5500. Next slide, please. So one of the biggest questions I get related to subplans are, forward one slide, please. There we go. So one of the biggest questions I get about these subplans are they right for my organization? And the answer, the answer to many questions is it depends. If your intent is to continue to pay your employees during the leave or furlough, especially if it's 100% salary continuation, then probably not. There's no real reason to supplement these employees, even if they receive state unemployment benefits in addition to their pay, because their take-home pay has not gone down. If you don't continue your employees' pay through the furlough leave period, then you may want to consider this, especially if you want to help your employees in this time where they may, realize additional financial burdens, and especially if you're hoping to retain or recall most or all of those workers when this is done. Now, having said all that, we've had a lot of interest, like I said, recently about subplans, but this was all before the CARES Act was passed by the Senate and will be presumably passed here soon by the House and become law that greatly expands the state unemployment benefit by the $600 that both Erik and Rebecca talked about. So in that case, that federal assistance will also relieve, or if you want to say supplement, the employee's state unemployment benefits. So maybe in light of the new federal stimulus package, a sub plan is not necessary in order to help reduce employees' financial burden. Next slide, please. So another big question, shifting over to health and welfare area, is do I have to continue my employees' health benefits during the leave, layoff, or furlough, or however I'm classifying this period where my employees are not working? And I think that depends on a couple issues. First, if you're actually laying off or there is a separation of employment, your employees are probably not eligible to continue their health insurance, at least as an active employee. And it would be treated as any other separation of employment. And if you are subject to COBRA, this may trigger a COBRA requirement. If you're putting your employees on a leave or a furlough, you may want to check your certificate of coverage. Most of these certificates require an actively at work requirement. So even if you're paying an employee during the leave, if they're not actively at work, then they may not be eligible to continue benefit their health insurance during the leave. If your certificate does provide for coverage during leaves, then they are probably likely eligible to continue benefits during this period. If it doesn't, they're probably not. However, I understand that many, if not most, insurers are now allowing employers to add for a continuation of coverage during leave periods in light of the COVID-19 pandemic. Next slide, please. Another question I've started to get more recently is, okay, I'm going to continue my employee's eligibility during the leave or furlough period. Can they voluntarily drop coverage if they want? If you're putting your employees on paid leave, this may be a possibility, but remember, if employees are paying their portion of the coverage on a pre-tax basis, Section 125 of the Internal Revenue Code restricts the type of mid-year election changes that employees can make. So this may be permissible if your employees are going to be dropped below a 30-hour threshold, and the employee represents that he or she will roll in minimum essential coverage elsewhere by the first day of the second month following the date they request to drop coverage. And again, this assumes this is permitted in your organization's Section 125 cafeteria plan or flexible benefit plan. If you're putting these employees on an unpaid leave, this is probably not an issue because the Section 125 issue is removed because the employee is no longer receiving pay for which pre-tax deductions are being withheld. Now, keep in mind, however, though, that an employee is generally only entitled to enroll in coverage outside of the annual open enrollment period in the event they have a HIPAA special enrollment period or HIPAA special enrollment opportunity. Once the employee is recalled to work, that return to work is not necessarily a HIPAA special enrollment opportunity and will not necessarily allow the employee to re-enroll in coverage when they come back to work. So unless your carrier is willing to waive that restriction, which may be likely, the employee may not be able to re-enroll in coverage until the next annual open enrollment period. I think that's something that employees need to think about if they decide to drop coverage during the leave period. Next slide, please. Another question that my partner Jeff Gray covered yesterday is, can employers suspend their employer contributions to the 401k plan? I think the first way to think about this is if you're providing a matching contribution and your employees are put on an unpaid leave, this is going to be kind of an automatic suspension. If an employee is on an unpaid leave, they're not going to make any their own pay deferrals to the 401k plan, so there'll be no pay deferrals to match. If your employer makes a non-electric or profit-sharing contribution, you can likely suspend this contribution if their plan uses a discretionary formula. However, if the formula is not discretionary and is set forth in the plan document, this may require an actual plan amendment. In both cases, a prospective communication should be distributed to employees about the suspension of the employer contribution. If you maintain a safe harbor plan, please note that you may be able to suspend your employer contribution, but it's a little bit more difficult. Again, Jeff Gray discusses this in more detail yesterday, and you're going to want to make sure that if you try to suspend employer contributions under a safe harbor plan that all of your T's are crossed and I's are dotted. Next page, next slide, please. Can an employee, finally, another question I get is, can an employee voluntarily suspend their 401k pay deferrals or the contributions that they are making to the 401k plan? And the answer to that is yes, this is generally permissible. However, employees would have to follow the normal plan rules for changing those contributions, which is most plans usually permit at any time, as long as it's on a prospective basis. To quick round things out, I don't have slides on this, but just to give you a quick overview on some of the benefit-related provisions under the Cures Act. Under the Cures Act, from generally most retirement plans, they will allow what they're calling coronavirus distributions. So these are distributions that individuals can take if they've either themselves or their family members has actually tested positive for coronavirus, not just showing symptoms, but tested positive, or has suffered adverse financial circumstances due to a number of coronavirus-related issues. The important things to note is that there's no additional 10% tax on these distributions. The distributions cannot exceed $100,000, and they can be repaid at any point over a 3-year period. And if they're not repaid over that 3-year period, they will be included in the employee's gross income ratably over that 3-year period, unless the employee elects to have it included in income in the year of the distribution. As Erik mentioned, there were some changes to plan loans. So beginning in the 180-day period, for the 180-day period after the enactment of the Cures Act, loans which were previously limited to the lesser of $50,000 or 1/2 of the participants' accrued balance in the 401k plan could be loaned. Those limits are increased to $100,000 and 100%, not 1/2 of the participants' accrued balance. For folks that have an outstanding plan loan on the date of the Cures Act is enacted, it appears that any loan payments during the rest of 2020 will be delayed for 1 year, and then appears that it will be re-amortized and doesn't need to include the 1-year delay period. Similar to 2009, the financial recession in 2009, it looks like waivers of required minimum distributions will apply to certain plans. Also, a provision I think some employers will be interested with as cash flow frees up is for the remainder of the year after the act is passed, employers can make payments to employees under an educational assistance plan to help the employee pay student loan payments. It appears that this will only be for qualified education loans, which is my understanding that those are loans that the proceeds were only used for qualified higher education expenses, and the typical limit under employee education assistance plans under Section 129 of the Code, that limit of $5,250 will still apply. Shifting gears a little bit to the Cures Act health and welfare provisions, it amends the FSTRA with respect to what is covered diagnostic testing under COVID-19. There are some small amendments about that. It addresses some rapid coverage of preventive services for coronavirus, so it touches on some of the ACA's preventive care requirements, specifically when new recommendations are made as preventive care. There's an acceleration date at which plans must provide those. And finally, the definition of it includes certain over-the-counter medical products as qualified medical expenses for purposes of paying for those expenses under an HSA, Archer MSA, Health FSA, or a health reimbursement account. But again, these are just quick overviews. We will be continuing to dive into the benefit-related provisions probably address those on another webinar and in some type of client update. And with that, we can move to the next slide.
Thank you, Tripp. This is Erik speaking again. I've been responding to some of the questions that have been submitted in the Q&A in relation to the SBA programs, especially the payroll protection or retention loans. A couple of the most frequent questions, which I'll just address for the benefit of the group. One, which was posed by a few people, was, does the loan forgiveness count as taxable income, which typically, forgiveness of debt would, factor into your taxes. That this is specifically addressed in the CARES Act, and it's not included. The forgiveness would not be included in taxable income, just to address that point. There have also been some questions about what if I've already laid off or put some employees on leave prior to this? How does that impact my ability to participate in the payroll protection program and loan forgiveness? There is flexibility built into the Act in recognition of the reality that obviously a number of businesses have had to lay off employees prior to the enactment of this program. And the Act does envision that, if you bring those employees back at a later date, there will be adjustments to recognize that in terms of your forgiveness. So it's a bit complicated, of course, but basically you're not disqualified from this because you've already laid off some employees. Provided that you ultimately bring them back, you may still be eligible for the full loan forgiveness or mitigate anyway the reduction in forgiveness. Any typical questions, Rebecca, that you want to answer on your topics?
I've been answering lots of them in the last 10 or 15 minutes or so. One of the questions that came up more than once is childcare. If an employee cannot work because of childcare, because the child's school or daycare has been closed, they qualify for benefits under unemployment, emergency paid sick leave, and FMLA. But if they can work, right, if they can telework, if they have someone else caring for their children, they would not qualify. So it's not automatic just because the school is closed. They have to actually not be able to work, right, because of that. Another question, because the new federal unemployment benefits are so generous, employees might want to stay on it, right? Even after we offer their job back, after the crisis passes, what happens then? They would not qualify for benefits anymore once they have a job to come back to. The benefits are only available for the reasons specified in the Act, and it's if they can't work for any of those reasons. Hopefully this will pass. We know it will pass. Hopefully it will pass sooner rather than later. And when that happens, if they don't come back to work, you can fire them. And if you fired them for refusal to return to work, they would no longer be eligible for those benefits. I think those are the most common questions for me, Erik.
Okay, thank you. There have been some other questions on the SBA front about just kind of I'll call it kind of plumbing of how the forgiveness works. And it's going to, all this new program will be affected through a vast network of eligible financial institutions. So my quick reading of this kind of plumbing portion of the loan forgiveness program is basically that the bank that administers the loan would forgive repayment from the borrower and then get paid by by Treasury. That's kind of a high-level answer to that question, although there may be more specifics as we get some further guidance. Looking at some of the other questions right now to see if there's other things that we can answer that aren't very specific. Anything you want to address, Tripp? I don't know if you've had a chance to kind of look through the questions.
Yeah, I'm looking through. It doesn't look like I have any specific questions to me yet.
Okay. I think there are a couple questions in here about there's at least one about a not-for-profit that would actually be looking to add staff to meet community needs and whether they would be available to apply for a Paycheck protection loan. I believe that may well be, but there are also other programs in the CARES Act that will provide additional financial support for communities, community organizations serving those types of needs. So I would say, before you take on a payroll protection loan, there may be other options for funding under the broader legislation for a community organization such as that. Another question that I think has come up from a few people is basically, I'm trying to decide which course to take, as between the disaster relief, the Michigan specific options, the payroll protection program. And I would say, because at least with respect to the federal programs, you're not required to take the money if you're approved. My thought would be that if on the face of it you're eligible for all of them, there's no, other than the time investment of putting together the application, there's no real downside in applying to multiple programs for potential relief, and then seeing what you may want to ultimately take on if you're approved.
Erik, this is Rebecca. I've had several questions now. I've been typing in the responses live, but it's come in over and over. So I'll mention it here too. That $600 federal unemployment benefit, as it stands right now, it is a flat $600, which means it's not tied to what you would normally make. It is on top of the state benefit, and it will be administered through the state unemployment agency. So as far as I understand it, right now, it's not an additional application or process. They will get it along with their state unemployment benefit.
Okay. There was a question about folks who have both full-time employees but also 1099 contractors. Is relief available for the contractors? That's one of the themes of the expansion of both the payroll protection program as well as the unemployment insurance protection program, is that both programs would bring within their coverage independent contractors. So they should be, depending on their business and their personal circumstances, they may well be eligible to participate in those programs, but they'll have to, I think, make that on their own initiative and not kind of through the business that engages them. Okay. There are a number of other questions, and we're past our time allotment right now. We have a number of people within the firm, obviously, who are working their way through the legislation that is winding its way through Congress and hopefully will be signed into law by Friday. And we will, of course, be following up with client alerts and future webinars that are more targeted to some of these questions, and to provide more guidance on some of the calculations, for example, related to employee retention and wage stability that would make you eligible for the retention loan or payroll protection loan relief. So I'm sure we'll have more to say about this. I hope people have found this initial presentation relating to some of the programs at a broad level to be helpful. And we're available. If you want to reach out to us, please do so, and we can either respond directly or bring in colleagues of ours. We're working on a cross-functional basis, as we've said, and have also been in touch with community organizations who are involved in administering some of these programs. So we'll help people make the right decisions and in a timely fashion. So with that, we'll conclude the webinar, and thank you everybody for participating. Apologies if we did not get around to answering all of your questions, but know that we will try to do so in future events or in direct interaction. Thank you.